Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. Hope you guys are doing well. Take a little break over the summer. We are back in action though. We actually were busy with clients, busy with some personal and business projects. But we're back here to give you a market update and let you know where things are. Now, originally we had forecasted with MBS Highways information and data that they were giving us that we were looking at lower interest rates by May of this year. And, by June, July, it was going to get better. Well, what we always say, what's likely to happen should happen, with year over year inflation dropping and all that. But then we had issues with the debt ceiling. When you print more money and you have a bigger budget than you originally planned on, which is exactly what happened, and you print more money, it just causes more inflation. The more you print money, the more inflation you're going to have, and inflation drives interest rates. So interest rates, that was a big part of why interest rates went up. Also, we have, we had issues with the banks. We had poorly managed banks, issues with banks, issues with the Fed's fund rate being raised so high, so fast. And these banks are selling treasuries and bonds to keep up with depositors' money. And that also has been causing part of the issue. So we're still hoping that by the end of the year, we'll see that, year-over-year inflation hopefully will subside. That's a lot of what we've been hearing from the Fed too. We'll see how that all goes. But I'm going to share my screen with you here just to kind of dig into the details a little bit more. And I'm going to be having a lot of other short videos kind of breaking all this down, the cost of waiting. Should I buy? Should I sell now? What's going on with inflation and all that. I'm going to have some shorter breakdowns on some of this right straight from MBS Highway. So you can kind of see some more of the details here. But, this year, for this year earlier, Goldman Sachs had said that the Phoenix area, along with Texas and some other areas, we're going to be looking at a 25% decrease in home values. And that didn't happen, nowhere near that. As a matter of fact, we haven't even seen a 5 or 10%, decrease in home values across the board. We started with a median sales price in January of about 410. That is now right around 440. And that's the median, which is going to be lower than our average sales price, which I'll get into in a minute here. So experts are bashing Goldman Sachs because of that. And that's even with these crazy interest rates. Today's rates showing at this 7.12%. Now, with a mortgage broker, again, these are just averages. So with a mortgage broker like we deal with Modern Home Lending, you're going to see lower rates than this. Typically, lower fees, no processing underwriting fees, and all those sorts of things. Also, closing on time is always a big deal. But that's one thing we pride ourselves on. But even with these higher interest rates that should have been down by now, but are not, we're still seeing prices steadily go up. Now, part of that is due to low inventory and low new inventory. Right now, we are sitting on the MLS, all active properties on the multiple listing service where 99% of homes are sold for sale. We're just over 11,000 homes, 11,600 and some odd homes, all property types. Okay. So that's where we are now there. And a lot of people sitting on the sidelines waiting. Now, if you're not paying any rent and you're living at home or with family and you don't have to worry about paying any rent or whatever, maybe it makes sense. But if you're paying rent anyway and you're not gaining any equity, depending on what you can afford, of course, but if you're just kind of waiting on the sideline for the market to crash, we don't see that happening with the super low inventory that we have right now. It just doesn't make any sense because during the housing crash, builders overbuilt. We had on the MLS, we had like 58,000 homes for sale. Now we've got just over 11,000. Numbers don't kind of hash out. A balanced market would be 3, 4, up to 6 month supply, and homes were at 2.3 this week. Just not seeing anywhere near the indicators that would make a market crash here in Phoenix anyway. And across the country, we're not seeing it either. Here's something that I just thought that, this is our son doing a little video. He's a loan officer with Modern Home Lending, and kind of explains it in a way that maybe would make sense to first-time home buyers and people on the fence out there. I'll dig into more of the numbers here in a minute, and along with some other cost of waiting videos and charts and stuff coming up from MBS Highway. But here's kind of a little video he put together, and I thought I'd show this to you guys. I thought this would kind of help to make sense of this and what maybe where we thought things were going to be this year, where they actually are, from the experts to us, and what we've been saying, and where things are headed. So here we go.
Hey, John, how's it going? Hey, Andrew, I'm good. I actually just signed a lease on my new apartment. That's awesome, man. I just signed the final documents on my new home that I purchased yesterday. Dude, are you crazy? Rates are super high. Why would you do that? Well, luckily, the home I really wanted was discounted to $300,000 because there's not many buyers trying to purchase a home right now. My down payment was only $9,000 or 3%, and my principal and interest is only $1,936 a month. A big bonus was the seller paid for all of my closing costs, including a year of HOA fees and a home warranty. Dude, you should have waited until next year after the election when rates are going to go down.
Eventually.
Hey, Andrew, did you see the interest rates are finally down to 4%? Yeah, that's awesome news. For sure. I just purchased your neighbor's home, which is the exact same as yours. I'm glad I waited until rates came down. My principal and interest payment is only $1,551 per month. That's great. I just refinanced my home with that same 4% interest rate and got a new principal and interest payment of $1,459 per month. Wait, you bought when rates were 7%. How's your payment lower than mine? Well, I had a higher payment for a year, but when rates dropped, competition increased in the neighborhood and my home's value went up. I gained over $44,000 in equity and refinanced my balance of $288,044. Man, I should have bought what you did. My same 3% down payment was higher than yours because the home I purchased was more, and you got all of your closing costs paid for. I had to pay out of pocket for all
that. And guys, right now, here's a pro tip for you. So the cost of waiting is you lose all that equity, the tax hedge that comes along with it, the inflation hedge that comes along with it, your compound interest that comes along with that over time, where you're paying down your balance of your principal on there. But right now you can actually go out and buy a brand new home. And, the way things are headed this year, just even if rates don't drop modestly, we're looking at probably at least a 5-6% increase in property values. So, I'm not really understanding any further, like why people are waiting, because again, that inventory is so low. We're not going to see a crash, guys. It's just not going to happen. Have the rates slowed things down and the affordability of everything kind of slowed things down? Of course. But it doesn't mean that it's dead. Okay. So I thought that just would illustrate things in a fun way for the video. But where we're looking at where we are right now, where we're headed. Just nowhere near any of the doom and gloom that we've been hearing about. So, so this is just from MBS Highway. This is a little idea on some of the data, economic numbers. And I'm going to kind of sum it up here. But bottom line, are they going to raise the rates again? The Fed's fund rate, which doesn't directly correlate with mortgage rates, but we'll see. Another indicator too, before we get into this, we're seeing our seasonal type stuff with our list prices, our average sales price and all that. We haven't really seen any kind of a dip there except for the normal seasonal stuff we see with our winter visitors. So for us, summers are a little bit slower just because it's so hot. A lot of our winter visitors leave and things like that. And now, let me just run through the numbers here real quick on this before we get into that other data. 64 days on market, it's kind of a normal market. 2.3 month supply, absorption rate, that's all normal. Average list price, average sales price, that's definitely up since the winter, since the beginning of the year. So, and the average list to sales price ratio is very healthy. Anything over 98% like that, right around that 90, just over 98% is very healthy. We see that under 500,000 too, which in today's dollars is an affordability marker, right? You can see that just over 50% of the homes are priced in there. And I'll tell you with the pro tip that with new homes, there are new homes that you can buy under $400,000 and just over $400,000 if you want a larger home. But there are areas that are in town, pretty close to town, where right around that 400,000 mark, you can get a brand new home. And the builders right now, they don't have a lot of inventory like we would want to see, because they don't want to overbuild like they did in 2008. It's not an issue right now, but they are offering lower interest rates. So they buy basically loans in bulk. Let's just say loans in bulk. They buy all these loans in bulk. And some of them are offering paying all your closing costs or closing costs and then some that you can use to pay down your rate, or they're just offering no closing, they're paying off all your closing costs for title and escrow and lending and all that. And maybe they're offering as low as I've seen, 5% on an interest rate. So with a brand new, and that's with a brand new home. Now, every builder's different. They're all offering different incentives. Even with some builders, it's on certain homes that are already being built that they're offering this on. But, we can kind of navigate through all that, figure out, which communities, which homes might work best for you. But anyway, we work with that all the time. And we love to help people, kind of figure that out, save a lot of money there on that, that way. Okay, so now we are in a seller's market. This is from the Cromford report. This is their market index. And anything over 110 is a seller's market on the market index. Anything below a 90 is a buyer's market. So we're over 110. We're at 157.6 as of yesterday. That puts us in a seller's market. Obviously, when we were in the crazy seller's market, a year and a half, 2 years ago, this was more like, 400 or more, but it's still a seller's market, well within the range of that. And demand is not as high as we'd like to see it, but it is higher than supply. So your supply is in the low end, your demand is in the low end, but your demand is higher, and they are pretty far apart. And those two numbers are the same. You're in a balanced market, and that's not obviously where we're at. So, whoops. Okay, let me get rid of this. Okay. So, from their MBS Highway report this week, are there going to be rate hikes that may affect how much it costs to, use your credit card, buy a car, or get any type of credit at all? And again, it indirectly will affect mortgage rates, but not directly. A lot of this stuff's baked in already. So since there's some of that uncertainty, we also had, like I said, the debt ceiling issues with, how much the government's going to be spending and printing for money, which that's out of control. But that's another story. That's causing inflation. Whenever you print more money, it causes inflation. When, you know, we're now seeing issues with our currency even on the horizon, if we don't get control of that situation. And again, banks selling off treasuries and bonds to pay for, you know, depositors' money that was being withdrawn. We saw collapse of some banks. So, you know, that all caused the higher uptick in inflation for mortgage rates. Now, there's going to be a jobs report this Friday, which will be an indicator of whether or not these higher funds rates are, you know, restricting employment enough. We've already seen people's in certain sectors getting unemployment. We've seen hours cut in certain sectors also. Now, existing home sales, because hours cut obviously is kind of working towards getting laid off, right? Or, yeah. So existing home sales constrained by low inventory. Okay. We see across the board, across the country, month over month, year over year, inventory is down. Okay. That's the bottom line there. But, you know, with the higher rates and a little bit of that pent up demand of people kind of waiting on the sidelines, and also the, you know, doom and gloom thing that didn't happen that we were talking about before, we've been talking about for months, that kind of kept people on the sidelines. But I think people are starting to readjust, you know, with these rates. They're starting to readjust, you know, with the idea that we're not going to have a crash. There's just not enough inventory, nowhere near enough inventory for there to be a crash, which caused the other crash in 2008. So new home sales reached 17-month high. However, you know, of the 437 new homes available for sale at the end of July, only 75,000 were completed, with 254,000 under construction and 108,000 not even started yet. So tight supply. And then this is across country median new homes sales price was 436,700, which from a year ago was down from 478. Okay. So, and it gets into, this is not the, you know, same as appreciation, but represents a mid price and can be skewed by the mix of sales among lower priced and higher priced homes. So it's different than the average. Average is always going to be higher, but this is from reports from Case Shiller, CoreLogic, Zillow, Black Knight. In other words, you know, federal housing, all the data points where all this stuff comes out of. The taming of unemployment, you know, initial jobs claim fell by 10,000 in the last week. And this, you know, the idea is they're trying to raise the funds rate so that there isn't more money being spent or borrowed to be spent for product development, acquisition of, you know, new businesses and that sort of thing, which slows down economic growth, which slows down inflation theoretically. So that's kind of what they're going for. In my opinion, no, we need some better ideas. We need some new leadership in there. We need some better ways to kind of get the economy going, you know, with energy and things like that, because that just kind of is kind of the core really of our whole economy when you think of a modern economy, right? So for energy dominant, that would really change things quickly. But that aside, we see that the next meeting is going to be September 20th. So that's really it in a nutshell, guys. If you guys have any questions at all, that's the Fed's meeting. Yeah, somebody just chimed in. That's the Fed's meeting. That will be September 20th. So we'll figure out if they're going to raise rates or not again, Fed's rates again at that point. And a lot will depend on the jobs numbers that come out this Friday. So keep an eye on that too. So guys, I'll be putting together some other videos, some really short videos straight from us here at Mincola Group. that will be coming from MBS Highway. We're also going to try and get a loan officer or two on here for you. But if you guys have any other questions at all, reach out to me and my wife Cynthia directly, and our team here at the Mincola Group with West USA Realty at 480-788-8569. You can call or text us there. Also check us out at mincolahomes.com, mincolagroup.com, and you can always email us at home@mincolagroup.com. Talk to you guys next time. Thanks.